Is there a tug of war between the government and the central bank? Last week, the government asked Shaktikanta, the top boss at the RBI, to step down, and people began to question whether the central bank was really independent. See, the problem stems from this. Das was a hawk. He was worried about inflation and kept interest rates high. But the government wanted him to be a dove, consider growth and cut interest rates. And this got us thinking, do we really need central banks to be independent? Because if you think about it, central banks have three goals: keep prices stable, grow the economy steadily, and ensure financial stability in the banking system. And those are goals that even the government cares about. But the reason for this separation is simple, and it's to do with the political business cycle theory. Put simply, this theory says that a business cycle will mirror the schedule of the election cycle. For instance, an incumbent government might lean towards spending money before an election to drive growth. They want to show high GDP and low unemployment. They'll pay less attention to inflation, and only once they're re-elected, they'll focus a bit more on inflation. But this then creates the problem of time inconsistency. This means that you make a plan today thinking that is the best plan for the future, but when that future arrives, you realize the flaws. For example, if the government lets inflation run amok thanks to its growth focus before an election, it might get too hard to bring inflation down again by tweaking interest rates. Because people take time to respond to interest rate changes, and you could have a situation where the fear of inflation is built into the psyche of the population for a long time. It happened in the US in the 1970s when the government had control, and that's why we need central bank independence.